Risk is in relation to the volatility. So volatility is your investment to the benchmark index. But we have to make sure that the benchmark is an appropriate benchmark for your risk tolerance. So the first part is determining your risk tolerance. And I got a whole thing on that one too. The second part is how is the investment behaved compared to that risk tolerance? Oh, kinds of fun stuff. So return. You have risk, you got return. What kind of return based on the past can we sort of anticipate? And generally, what we're looking at is the higher the risk, the higher the return. But there's also a great phenomenon, and I think it's called value investing, where you can take a lower risk and get a higher return. And I love that. That keeps people invested. That keeps complaints away. I like it when I can have a path where people will stay invested and not get nervous as much. Like I talk about in my favorite funds, they went down 30% and 40% back when the whole market was down 50%. I mean, no, I wasn't at that firm anymore, but I would then say, look, we're down 30, could be worse. Now, 30 sucks, but it still could be worse. So we have risk, we've got return, we've got costs. What are the costs of investing? And this is a lot of how is the broker or advisor being paid? And that depends on your time horizon, right? Are you investing for 5+ years, or really should be 3 years plus, or if it's going to be short term? And by the way, the shorter the term, the less risk you should be taking with that lump sum. So I've had people in the past, they said, well, I just want to invest for a couple of years. And this was before 2008. And so I put them in something that was moderate, very, very moderate, rather calm, I would hope. Once 2008 hit, everything, the rules went out the window. And now investment advisors should be far more conservative and be declining some of those transactions. I wouldn't want the risk and liability on those anymore. I'd say if you really want to invest in that, go to Fidelity, go to TD Ameritrade, go to, wherever else, do it yourself, because I don't want the liability. But so anyway, there's different costs involved. Now there's terms. Everything has different terms available. So which it just depends, like annuities have their different terms. Annuities have, I call them house rules, and then they have IRS rules. Got to know the difference between those two. And will those terms fit in your overall objectives? It's just something that has to be kept in mind. So just because you have something that has a great high risk, high return, doesn't mean it's still right for you, depending on the terms and conditions of what it is. What I basically say is the problem in the markets is that when all of your money is already tied up in the markets and the market goes down, what extra money do you have to invest? You generally don't have any.